Okay, so today we're looking at section 18.4. This is the last section of this chapter, and you can tell by the title, we are acquiring more capital. We've looked at other ways of acquiring capital. Some we have to pay back, and it's a debt, either short-term or long-term notes. We've looked at acquiring funds by having people invest in our company and we give them stock in exchange, and so no pun intended. So that's called equity financing. Well, today we're going to primarily look at the second of these two objectives, and that is the impact of what we call financial leverage. And if you want a definition of leverage, a textbook definition, it's that. And it's basically the business ability to take borrowed funds and increase their earnings, okay? Increase the performance of your company by borrowing money. And there are some people that are great success stories. They've started out with virtually nothing, and they acquired capital by borrowing, and they turned that around into multi-million-dollar businesses. And that's really a success story when it comes to leverage. Now, it doesn't always work out for people. Some people borrow a lot of money, their business fails, and then they're filing bankruptcy. But when you can turn borrowed money into a successful, growing company, that's where leverage is used to your advantage. And that's what we're going to be looking at in this lesson. So I want to help you with this problem, this work together problem, and talk you through it. And you might want to make some notes on how we got some of these numbers, because you're going to have to turn around and do the same type of thing on your own problem. So 573. We have KMT Stores. They are thinking about renovating its store. The only reason for thinking about that is it's the possibility of increasing our earnings. There's no other reason for renovating unless you think it's going to turn around into more profits, making more money. So what we're going to do is analyze the impact of leverage with really three different scenarios. So let me explain what this is all about. You see this outcome column, and there's a 6%, 7%, 8%. What this is referring to is, what if we have a 6% increase in operating income as a result of this renovation? And then what if we have a 7% increase and then an 8%? So this is the impact. If you're wondering what are these percentages all about, this would be the impact or the result of the renovation, what it does for our company. We're hoping that, well, we're just analyzing three different scenarios. These are percentage increases in operating income. All right. So considering renovating its store, the project will cost $100,000. Okay. So right off the bat, we're going to do 6% times 100,000. So if you want to note, you can put over here the project cost, which we're told in this case was $100,000, times these percentages. Okay, so for the 6% outcome, it's 6% times 100,000. That should be 6,000. 7%, of course, should be 7,000. 8% should be 8,000. So these are increases in operating income as a result of doing this renovation. Okay. Now let's take a look at interest expense. Well, notice the wording. The company can issue 7% $5,000 bonds to finance 90% of the project. Okay. So in other words, we're going to be, the whole cost of the project is $100,000. Well, 90% of it is going to be financed. It says 90% of the project will be financed through bonds. And what is the interest rate on those bonds? 7%. So let's do this little calculation, 90,000, 90% of the cost times 7. And that same number is going to be written all the way across. That should be 6,300. Okay, this next line, net income or loss, if this is the increase in earnings and we have this much increase in interest, we need the difference. So I'm just going to put difference here. Or you could put subtract. We're going to be subtracting these numbers. And of course, this is going to be a negative. We're taking operating income minus interest expense. And the same thing here, operating income minus interest expense is 700. And this should be 1,700. Okay, now we're going to calculate income tax on this difference. So I just put 25% of the difference. Well, obviously, if you multiply a negative times 25%, you're going to get a negative result. 700 times 25% should be 175. 1,700 times 25% should be 425. Okay, any questions so far? So how we got this line was taking this difference and multiplying by the tax rate, 0.25. Okay, now we're going to subtract again. So I'll just put subtract. Now you got to be careful. Remember math. This is negative 300 minus negative 75. When we subtract a negative, what does that mean? We're going to be adding. So negative 300 plus 75 should be, well, we don't do negative signs. We just use parentheses. Should be negative 225. 700 minus 175 is 525. 1,700 minus 425 is 1275. Okay, well, let's think of this last line like this. How much did we say the entire project is going to cost? 100,000. If we finance 90,000, then we are going to invest of our own money the rest, which is 10,000. So over here, maybe just a little note, project cost, which was 100,000, minus the amount that's financed. Okay, so return on investment is calculated as follows. It's net income after tax, net income after tax divided by the investment. So somebody tell me if you do, of course that's negative. This is going to be a negative result, and we'll round it to the nearest tenth of a percent, 1 decimal place. So 225 divided by 10,000. Anybody got that? Okay, so let's make that into percent. That's the decimal form. So 2 places to the left. Okay, and it's going to be negative 2.3%. So we'll round to the nearest tenth. Okay, same thing here, 525 divided by 10,000, 5.3%. And then this one should be 12.8%. Okay, so number two, part two is kind of a summary in words of our analysis. And we could look at it this way. As long as we end up with either 7 or 8% growth in operating income as a result of this renovation, we're going to have a positive return on investment. A 6% growth with the renovation isn't going to be worth the investment because we're actually going to lose money on our investment. But either one of these, obviously, if we could get to 8%, that would be ideal. But with either one of these outcomes, either a 7 or an 8% growth as a result of the renovation, we will have a positive, what we call ROI, return on investment. So we could summarize it kind of like this. KMT stores will earn I'm just going to abbreviate positive return on investment, which is what we're always looking for. That means we made more money off of our investment. We will earn a positive return on investment with increases of either 7% or 8%. Something along those lines. We definitely need more than 6% to make it worth our while. Okay, so that should be pretty straightforward. You're going to do the same type of thing on the on your own problem. I think we'll check that out, and then before you go on to the application problem, let's see what that looks like, and then we'll go from there.